So I'm going to say a few words about a 10,000-word research paper that I published, and I'm going to distill it to about 25 minutes with time for Q&A. But I will be here all day, so happy to talk further if this provokes further questions. A little while ago, I published a research paper with 3 Columbia MBAs, ex-McKinsey and BCG, on what are the best practices of VCs in supporting their portfolio companies, accelerating their value. One of the cliches of investing is that diversification is a free lunch. I think there are 2 other not free lunches in investing. Platform, right? One of the things I like about our industry, private equity and VC, is you can systematically increase the value of your portcos, which is you can't really do in public markets investing unless you're an activist. And in addition, there's operational alpha, right? If you run your firm well, you're on top of your data, you're diligent about that, then you can avoid things like night trading, a well-known investor which blew up because they didn't have their operational processes under control. So this costs some money, but I can very confidently say this will help you run a more successful investment process. So with my colleagues, I wanted to dig into how do you do that? How do you systematically support your portfolio companies? Our research paper is the #1 most read paper of the year in the Journal of Private Equity, so ping me if you want a copy. You do not need to take notes. Go text your mother or your father. You can get this full slide deck and a lot of other resources at that URL, teten.com/PA. And I'll share it again at the end. So briefly, and I'm going at high speed, given it is 10,000 words, I'm going to go through what are the levers that you have to support your portfolio companies, what are the archetypes of VCs that are using those levers, and then what should you do in your particular investment management firm to implement these strategies. Right now, I have a background building different VC firms. I was previously a partner at FF Venture Capital and Hoff Capital and Coolwater Capital. I'm now with partners helping to build Orange Collective, which is a VC firm that specializes in investing in Y Combinator companies pre-demo day. Y Combinator, most people don't know just how ludicrous the statistics are. The investors who invest at demo day systematically, their median return is a 5x. Top decile is 15x. So there are not too many places where you can get numbers like that. At Orange Collective, we're investing pre-demo day. So we aspire to even greater returns. As a young manager, we face this challenge ourselves. How do we design our firm and our platform function to enhance our returns? At the end of our presentation, I'll share with you the strategy we've chosen to use. So here's a summary of what we found in research. We found a correlation between firms that generate better returns tend to have a more developed platform function. We have a lot of statistically trained people here, so I'll bet you can figure out the problem with that analysis, right? The people who generated better returns, they have more money, they can invest in the platform function, correlation, not causation, I get it. But nonetheless, it is reassuring to see that basically matches our intuition, which is if you build resources to support your portcos, they're probably going to do better, and that's probably going to be better for your LPs. One of the things we particularly want to understand is what do the portcos value? So the things they value most, in rough descending order, are intros to customers, right? Revenues, recruiting, community, people like them, capital raising, especially in the old world where you assumed you were unprofitable. Now that's a little less popular in the current wave of VC. Board service, which you will notice is relatively low on the list, despite the fact a lot of VCs pride themselves on, I'm a great board member, and access, especially discounted access to vendors. We found most of the time it is free to the portcos to use these resources. This contrasts with the private equity world, where it's quite common that the PE fund, which remember controls the portco, will make them pay for access to resources. VCs tend to view it more as a lead gen and a marketing resource. And lastly, most folks are not fully leveraging modern technology and analytics to do this. And that's an area of particular focus for me. I run a community called Alts Tech, which is a partner in today's event, focused on how investors in alts can use AI data and analytics to systematically generate alpha. Our objectives were to understand what are the philosophies of the investors in supporting their portcos, how can they support their portcos, and then how should they self-assess what's the best strategy to execute. Our sources, we interviewed over 50 practitioners, My co-authors and I all have worked in the industry, in my case for over a decade, and so we had a lot of insight from folks, not up to the rigor of Heidi Knobloch, one of our professors here, but we try as amateur academics. So there's 7 main levers that investors have to support their portcos. And I'll go through them. The acronym, all good business research has to have an acronym, is TOPSCAN. So let's go through the TOPSCAN. So the first T, the first letter is T for team building, right? That's basically what the companies are building, are using your money on, right, is team plus calls to different AI tools. So it's very helpful to aggregate job openings. And this is a pattern in our research. The typical portco does not have a brand, right? You as a VC, you have a brand, maybe even a big brand, right? Like an Atomico or A16Z. And so firms like Getro help you aggregate the job openings across your portfolio, and that makes it easier for the job seeker to just go to your website and get referred to the right portco in the right city for their particular job situation. I also find that a lot of portfolio CEOs don't have experience in recruiting systematically. The paradigmatic portco CEO, they were a strong engineer, maybe they're a strong product manager. They usually were not a CEO previously, and so that is a skill set they're lacking. And so systematically training them in how do you actually interview, how do you hide or avoid the fake avatars that people are using to hack the interview process, right? Which is a new problem people have. That's very helpful in increasing the odds that the money that you just gave to that portco will in fact be spent wisely on appropriate talent. For a particularly high-end hire, I know of firms where the VC partner will fly out to meet one-on-one with that key Google executive and say, you have to join this portco, I'm all in, I'm a board member, I believe in it, you should too, right, to close the deal. Another way to help with team building is to help to lower their headcount needs. You can do that through systematic intern placement programs, often marketed as fellows, and through targeted fractional support. Typical portco, they're, say, 10 employees. They don't need a full-time CFO or a full-time CMO, but if you can help them get access to a fractional CMO, fractional CFO, et cetera, then they delay the point at which they have to pay the full rate to hire that person. As a father of a 20-year-old CS student who's looking for an internship, I relate to the value of helping place interns. That was an ad, by the way. So another way of team building is helping to figure out a career track across the portfolio. I think the gold standard for this is Welsh Carson, a well-known PE fund. They advertise on their website that a very high percentage of their portfolio executives previously worked at another portfolio company. One of the challenges in the way the economy works now is people switch companies every couple of years, right? 50 years ago, you would work up at the ladder at a GE, right? And you had a very clear progression, and HR knew you were good at your job. But when most people change jobs every couple of years, who actually knows if you're good? There's a lot of friction. So LinkedIn, of course, is trying to solve this problem, but they don't fully solve it. But the investor, if I validate, oh, that person was a good controller at her old company, she would make a good CFO. At the new company, right, I'm vouching for her. I'm acting like a synthetic HR function at an old school hierarchical conglomerate. And that's valuable to the employee, and it's valuable to the portfolio because they get better people cheaper. Next is operations, helping the companies run their shop well. So I run a community called Founders Next Move for tech founders in transition, and we help identify different service providers for emerging companies, and in some cases have discounts on those service providers. We find there's a lot of friction as firms say, oh, gee, I need a CRM, I need a fractional CFO. Who do I hire? How much do I pay them? Right? And every company has to go through the same process, and we're trying to speed up that decisioning process. We also try and allocate resources. So one company is having some layoffs, they have extra real estate, fine. We encourage another company to use that real estate. There are a number of firms that specialize in just identifying the service providers. I've listed some of them here. Another way to systematically support them is actually directly providing services. When I was a partner at FF Venture Capital, we found that our portcos were often not very good at their financial management. It was very rare we backed someone who's a former bookkeeper as CEO. Wrong DNA, right? So we built our own outsourced CFO services, which we ended up spinning off into a company called Graphite Financial, which provided that CFO function to companies, usually until they hit 30-person headcount, at which point they could justify hiring their own CFO. We charged at cost for that, because we felt it was a conflict of interest if we were trying to make a profit. And then we ended up serving non-portfolio companies and charging them at market. And that company actually got acquired by Kiwi Tech. Another resource is helping them connect with their peers. So Founders Next Move, which I mentioned earlier, is a community of founders who are ideating on new ideas or in transition. I built this because of my own past life as a serial founder. I started 3 companies, sold 2. You can guess what happened to the third. I'm a note taker, so I publish there a lot of my resources and what founders can do when they figure out what comes next, including what is the cheapest way to get my company off the ground, to identify the right service providers, tools to get into operation. Another way that you can add value to Portcos is perspective. When I think about my own career, I definitely did a lot of stupid things that I would not have done if I could just have stepped outside of myself and looked on as a third party and said, gee, is that really the right move? There's a direct analogy here to my teenage daughters who sometimes do things that are maybe not so smart, and I as a father say, no, don't do that. They say, no, we're going to make our own mistakes. So I think that that's part of the value of board service, right, is to help provide that outsider's perspective. And even if you're not a formal board member, if you have the right rapport with the CEO, you can give them feedback, you can provide some useful insight. It's good to do that on a one-on-one basis, but of course it's better if you have data, which we're going to get to. So, you know the aphorism, teach a person to fish, don't just give them a fish. So a good example of that is First Round's approach, First Round Capital, well-known VC. They realized one of the universal needs of Portcos was to pitch for capital. And it was such a consistent pain point, they developed a whole program, much of which you can get for free on their website, by the way, around how do you tell your story, how do you close the deal, how do you get the capital. And I've heard very good feedback about that. There's another New York VC firm, Primary VC. They built their own in-house expert network, which is free to the Portcos, right? You're basically making custom intros. And they specifically were not trying to get a bunch of fancy CEOs on the website. They wanted someone who is a head of engineering, head designer, head of marketing, right? The sort of mid-tier people. Because a typical CEO, when they talk with their CEO peers, they're hearing insights at an abstract level. If they have a question about engineering, it's more helpful to talk with a head of engineering and ask that person your specific issue. Another tool is basically replicating the university. Y Combinator, of course, does this at scale. Another example is Real Ventures, a Canadian firm, former client of mine. They run a founder camp every 6 months, which is effectively all the basics of starting a company. And the goal is not just to teach the founders, but to build community among all the founders in the real portfolio. So next is customer development, which I mentioned is #1 most valued by the Portcos. And Andreessen does this very well. They have a program for corporate America to fly out to Silicon Valley, and they'll set up meetings for you with all their Portcos who are relevant, right? So you're working at Ford, GM, and you're saying, gee, this whole AI thing, it seems kind of important. Who should I talk with to understand? And they'll say, oh, gee, I'd love to set up meetings with some of my Portcos who have products to sell you. It's free to the corporate, right? And so why would they do it? You can imagine that's very beneficial to the Portco to be able to be in the room. I run a syndicate called Versatile VC focused on investment tech, meaning tools that help investors generate alpha, Vestberry being an example of that. And we do the same thing through a network of executives at large financial services firms who are buyers of investment tech. Another way to approach this, which Mark touched on, is providing benchmarking services. So a number of firms have a big enough data set where they can say to you, what's your CAC and what is your peer's CAC, and help you figure out how you're doing versus the market. Of course, all these metrics are a little misleading, right? Because inevitably your business is a little different than the next person's business. But nonetheless, I of course agree there's a lot of value in understanding the market norms. Just with all data, you have to take it with that grain of salt. So Vesperi obviously is specifically focused on this issue about how do you systematically track the portfolio, make sure that you're allocating resources, you're triaging, right? There's this painful conversation that I've had every month in my various the VC firms, which I've been fortunate to build, of which companies do you just cut off, right? They're just going to run out of cash and there's nothing we can do, and which companies do you try and salvage. And so systematically tracking how they're doing and being able to make judicious decisions about how much energy to invest in each is, I think, really important, both reputationally and financially. So last part of TopScan is N, the network of investors. So no surprise, a CRM is key for this. You would be surprised at how many firms do not have an appropriate CRM. I know of one global top 10 P fund that you definitely know of that doesn't even have a CRM that everyone uses. Some of the partners are keeping key firm data on their cell phones. So they say, that's my relationship, right? And they want to keep the option value of being able to quit the firm and go keep those relationships. That is definitely not a best practice, but that's how some people do it. That's not what you should do. So in our CRM, we keep track of the investors in our ecosystem, what they're interested in, so we can make very targeted intros. Y Combinator, of course, has a particularly valuable alumni network. Many years ago, I did some work with Goldman Sachs, and I built for them something called Chambers Street Executive Network, which was a pool of very, very senior talent who we could second into portfolio companies on an as-needed basis. We didn't pay them anything. We just bought them dinner once or twice a year. But the idea was that we had a close relationship with them, and when we needed to fire a CEO, right, which happens, they would be the first person we call, and then they would be compensated by the portco at whatever economics made sense for that person in that company. Another good example is Hoff Capital, where I formerly was a managing partner. I joined Hoff when I was at 7 million AUM, now north of 2 billion AUM. Hoff has a particularly valuable LP network, LPs from over 37 countries, including dominant business groups in those different countries. And that's become a core part of the sales pitch to the portcos is we can get you into Lithuania. We can get you into Poland, where it's really helpful to know one of the dominant business groups that have disproportionate influence in those areas. Another example of that is AltsTech, which I mentioned earlier, my community for investors using AI and analytics to generate alpha. We run events and publish research to help our community to do their job better, and that helps generate customers for our portcos and helps to increase overall returns for us because we are hopefully better at our job. So I mentioned there are 3 archetypes of investors that flow from this. So the first archetype is the financier. So the financier, their model is, hey, I'm a finance person, right? I'm a banker. I'm a bro. They put the money in, and then they're usually pretty passive. This is not, I'm not saying this at all in a critical way. It's a valid model. The example of that is Right Side Capital. So Right Side is extremely active. They do about 75 to 100 investments per year. They have 4 employees. So you can imagine they're not spending a lot of calories on supporting the portcos. They have a very automated process to making assessments and writing checks. And then the portco goes off and does its own, and it's worked very well for them. Another example is Correlation Ventures. Their model is effectively an index fund for the top-tier VCs. Their sales pitch to guys like me is, whenever you have a round, a new round, meaning a new investor is coming in, they've priced the round, we'll fill it out. And they say, we're not trying to add value, right? We're going to fill out the round. So you might think, gee, if a company's raising a round, wouldn't they prefer to have, if they're a fintech-focused VC with lots of expertise, right? They should come in. The answer is, yes, of course. I prefer to have a fintech-focused VC to invest in the round. But you don't always have that luxury. Sometimes you just want the money. So Correlation Ventures comes in, they write a check very quickly, very quick DD, and you're done. And that's worked very well for them. So the next prototype persona is the mentor. So these firms say, I'm a consigliere. I provide one-on-one advice to the portco, but I'm not trying to build out a fancy platform. That's not the model. So these firms are often solo GP. I've listed here a few examples. And that also is a very successful model, right? They can make a lot of money. It's not a model that's going to scale because you're always limited by that one person's abilities and time, but it works. The last model is the platform model, where you're investing significant money in building out your resources. That's an upfront commitment, right? So you have to be confident that you're going to get returns. At my prior firms, FFVC and Hoff, we were fortunate to have some meaningful capitalization that enabled us to put real resources into our platform function that lowered our origination costs and we think increased the value of the companies over time. So that model is, we're doing it systematically, we're tracking the data of our portcos, and the king of this, right, the best example of this is Andreessen Horowitz and First Round Capital. They're probably the best known examples. First Round has invested very significant resources into building a community model. Their view is they don't want to be a hub and spoke model, right, where the founders go to the VCs and ask for advice. They want a spoke-to-spoke model, where the portcos go to one another, and the portco in Seattle can go to another portco in Seattle and ask for advice, get resources unique to that economy in Seattle. And that's more efficient, doesn't require the time requirements of the hub, right, of the VCs at the center. So for example, they have an in-house resource, which is like Yelp for startup CEOs. You notice there are a lot of resources online that say, Vesperi is great. It's harder to find people who will complain about a given service provider. So in the gated community that they have and Y Combinator has, you will see that. You'll say there are certain VCs or certain service providers you should not use, and here's why. And they can do it because it's not a public forum where they're going to get sued. So there are, of course, many other firms that have different models in between these, including Orange Collective, which I'm now working with. So I'll get into that at our end. So you have 5 main resources to increase your portco value. The first is cash. Cash is good, right? They even say cash is king. So if you have the budget, great. Everything I've listed here has some cost, varying from minimal to meaningful. The cheapest way, if you don't have cash, is making intros. There's a huge, huge amount of value. And I think especially in a world where there's so much noise, AI-generated noise, having an intro to a certified real person, right, not a fake AI person, has value. Next is brand. A great example of brand I mentioned earlier about this idea of recruiting, so the data bears this out. When the VCs that have systematic recruiting functions cold call and say, hi, I'm with Hoff Capital, and we're looking to hire an engineer for ourselves or for Portco, versus a recruiting firm, they have a 5x higher callback rate, which makes sense, right? People want to talk with VCs. There's option value in case they want to found a company. The VCs imply some sort of filtering. The recruiters, you know, they work for money. They'll recruit for anyone, no matter how low quality, if they're just paid. So it's not the same filter. If you have the brand, great. If you want to build a brand, the first thing I'd say is think about what can you be a leader in. You can't start off by saying we're going to be the world's best VC. You have to start off with we're going to be the best VC focused on Y Combinator companies pre-demo day. That's niche enough you can quickly build to execute that. Next is network. So networks, I think, are often underactivated because people don't know what is being desired. Oftentimes I have a meeting with someone and they say, oh, love to help, go on my LinkedIn and look for anyone in my network and I'm happy to make an intro. That's not that helpful, right? You're putting the burden on me to go through your 5,000 contacts. So figuring out ways to automate this, to understand what are my specific needs and then which 10 people in your network are most helpful, that's the way to provide a resource, right? To build your own positive brand rating by doing this in an efficient and systematic way. If you have a weak network, this is, again, is a whole topic, but the easiest way to build that out is to events and content, which, of course, is what I'm doing with Alts Tech and Founders Next Move. Expertise. So if you have in-house expertise, like in my case, I have particular expertise in investment tech, so we advertise that if people want to dig into that, we're available, open to our policy to discuss it. If you don't yet have that expertise, I would go and build it. I think the generalist model is very hard to execute on unless you have the resources of an Atomico or other large player. So I'm going to conclude with a case study of Orange Collective, the firm that I'm helping to build, which is focused on Y Combinator companies pre-demo day. we are a young firm, right? We've already had our first close. We have 150 Y Combinator grads who've invested in our fund. And we had this design question of what is our strategy for supporting our portfolio companies, which include the 2 highest rated companies from the most recent YC demo day. So first thing we did is we built a portal where we share in real time our investment memos, which are mostly AI generated, but obviously human supervision. And all the LPs have access to it. So Y Combinator is a known universe, but who's really good? Well, key to our logic is if I say to you, who are the most capable people in your undergrad class, you would have a view in that, right? You know who's the kid who's on top of things. So we're doing that in the YC ecosystem through our network of LPs who are YC current or alumni founders, and through our deep immersion in that ecosystem. That gives us insight. We put that into the portal, and then all of the LPs can log in and can see what we think about the different companies. And we make that very easy. You literally press a button, you can get a scheduled call with one of the portfolio execs if you want to invest directly in that YC company. We do periodic check-ins with the founders, and our model, I'd say it's 95% pull, not push. Meaning, if the founder wants your help, great. If they don't, fine. We're not usually taking a board seat at Orange Collective, so we don't have the power, other than reputationally and relationship-wise, to force them to do things. But we do want to be available to them. We help in recruiting, leveraging founders' next move in alts tech. And we also help in skill building just by virtue of the fact that my partners, I founded 3 companies, my partners have founded 5 YC companies, and so we've been through this before. We also do a lot of events. I was just reading the Times that people are moving away from online dating because they're burnt out on that. I see that happening in online as well, in the world of business-to-business matchmaking. And so we certainly are a believer in the power of events. We also are systematic about building relationships with the later round investors who are likely going to provide capital if needed to the companies in the verticals of interest to us. Lastly is we think that the first 100 days and the first few employees are absolutely critical in shaping the trajectory of the company. So we particularly pay attention during that first phase because we think that just like a tree that starts from a crooked base is not going to head for a straight and tall future, the same thing applies to a company. So I know I went at high speed. Happy to speak with any of you offline about this. I think we have time for 1 or 2 questions. Okay, so thank you so much, and look forward to digging into this further all day today.